So let's start with preferred shares and bonds, and let's look at some of these similarities. Well, preferred stocks are issued with a par value and pay dividends based on a percentage of that par value, just like bonds, which pay coupons that are a percentage of their par value. Okay, and the market value of shares of preferred stocks is sensitive to changes in interest rates. So if interest rates rise, the value of the preferred stock falls, and that is similar to the way that bond prices work as well. Preferred stocks technically have unlimited life because they have no fixed maturity date, but they may be called by the issuer. So like I said earlier, callable bonds and callable preferred stocks both exist and can both be invested in. And that is a way that a company can go about refinancing their debt by calling bonds or refinancing their other fixed income securities like preferred stocks by buying back the preferred stock and then possibly issuing new preferred stock at a lower rate. Okay, so that can be the case as well. Then, like bonds, preferred stocks are senior to common stock. Okay, so like I said earlier, when it comes to the liquidation of the firm, they are senior to common stock. If everything goes bad and the firm has to be liquidated, then the bondholders are going to get paid. The preferred stockholders will get paid with whatever's left after the bondholders, and then the common stockholders, they fall third in line if there's anything left later on. And they also fall third in line when it comes to payment, because obviously creditors are going to get paid first as far as the interest payments that they are due. And then any dividend payments that get paid to preferred stockholders will get paid before the dividends that get paid to common stockholders. And common stockholders typically aren't even able to get dividends unless they are already paid to the preferred stockholders. Okay, so that is another way that bonds and preferred stock are similar. They are senior to common stock. And then there are also convertible preferreds and convertible bonds, right? So we've got these different types of securities that they hold these same types of provisions, these convertible provisions. So you can convert both preferred shares and bonds into common stock if the prospectus of that particular issue says that you can. Okay, and so that is a provision that can give the investor the ability to take part in the positive performance of a particular company without having to, take full risk into buying the stock in the first place. They can just hold on to whatever they have that is convertible and then convert when it is beneficial for them to do so. Now let's look at some differences between bonds and preferred stocks. Well, as observed earlier, preferred stock is equity while bonds are debt. Okay, so preferred stocks are still a part of the equity portion of a company, right? They are still part owners, even though they are not the true owners of the firm. The common stockholders are the true owners of the firm due to their voting rights, but we'll get to that here in a little while. Most debt instruments, along with most creditors, are senior to any equity, right? So bondholders will still be senior to preferred stockholders, even though preferred stockholders are senior to common stockholders. So preferred stocks pay dividends, and they last for the life of whatever the preferred stock is, which can go on as long as the firm wants to let it go on, whereas a bond has a fixed maturity and is going to pay fixed interest payments. Okay, and so it's going to differ just a little bit because the dividend payments aren't something that has to occur, but the bond payments, the creditors to the firm must get paid, right? The bond payments have to be made, or else there's going to be much interest in seeing what happens to that firm because they have to pay their creditors. Okay. Now, while preferred stocks are interest rate sensitive, they are not as price sensitive to interest rate fluctuations as bonds are. Their prices do reflect the general market factors that affect their issuers to a greater degree than the same issuer's bonds. So the price of the preferred stock reflects a lot more the firm's performance than would bonds, right? Bonds don't care as much about the firm performance because as a bondholder, you just care that you get paid whatever interest and the return of principal that is due. You don't care so much about performance, but as an equity holder, performance is the name of the game. And so the performance is going to have a bigger impact on the price. And then information about a company's preferred shares are easier to obtain than information about their bonds. This makes preferreds in general easier to trade, and perhaps more liquid than bonds. I would corroborate that statement. And the low par value of the preferred shares also make investing easier because bonds have a minimum purchase requirement, right? Typically $1,000 for a corporate bond. So that's how bonds and preferred stocks line up with one another.